listener production.
Hey, Bension Siebert here for The Briefing. The stock market is crashing. But for those who don't use our spare time casually perusing the finance section over our morning espresso, today's episode is your go-to explainer on what the hell is going on and how it could affect you. Because not all of us are lucky enough to own shares, but the story of this share market crash is at its simplest level about the rising cost of living, i.e. inflation, and the tricky gamble the people in power here and overseas are making in their attempts to fix it. This time last week, everything was coming up Millhouse for Australian investors. The Australian Stock Exchange, or ASX, hit yet another record high after months of relatively consistent growth. But since Friday, markets across the globe have been tumbling. $100 billion has been wiped off the value of Australian shares alone. So what does it all mean? Dr. Angela Jackson is lead economist at Impact Economics, and she's here to help break it down for us. Angela, thanks for joining us. Before we get into what happened this week, let's go right back down to basics. What is the stock market and why should I care if it's crashing?
The stock market, broadly speaking, is where people buy and sell their shares in companies and other products as well, other financial products. And its overall value is I guess for many of us, probably our investment in it or our stake in it is through our superannuation fund. So we're directly impacted through that. But it is a pretty important bellwether in terms of the overall health of the economy and generally speaking reflects the value of companies that are listed on it.
Why did the stock market start crashing late last week?
So the stock market's been doing pretty well. It's been at record highs both here in Australia and in the United States. I guess there's been a lot of news at the moment about economy's been pretty slow and pretty weak, and obviously inflation and cost of living pressures, but we've seen the stock market hold up pretty well and be performing really well. However, in the last week, what we've seen is there was a little bit of disappointment coming out of the United States that their Fed Reserve didn't lower interest rates last week. And then there was pretty disappointing economic news out of the United States on Friday in terms of their unemployment figures showing an uptick. So there's a bit of nervousness out there in the market that perhaps the United States, the Fed Reserve has left interest rates too high for too long, and that's going to impact their economy and may cause a recession. And in fact, maybe that recession has kind of started if you think about it in terms of rising unemployment. So it's that nervousness, I think, that the markets are reacting to, and they tend to overreact. The thing about markets is they tend to move. There's big movements for a number of reasons. And so what we're seeing, I guess, at the moment is a bit of an overreaction to what was slightly disappointing unemployment figures on Friday.
Do you think that this is likely to continue?
Look, when we've seen in the past, and, if we think about the financial crisis back in sort of 2008, 2009, there we saw sort of 20 or 30% falls and quite sustained falls. That's when things become quite contagious. So, the impacts of the stock market then flow through to the banking sector and we can see, a real crash. I think this is more in the realm of perhaps an overcorrection, but a correction that we see from time to time, and probably hopefully something by the end of the week we look back on and go, yeah, look, the market's corrected somewhat, but this isn't a full-on crash that we've experienced. I don't think what we're seeing out of the US, yes, it's definitely an economic slowdown. We're definitely seeing that globally, but we're not seeing like a full-on financial crisis type recession environment. We're really seeing what is, the economy is responding to basically central banks really tightening their monetary policy, increasing interest rates, and we're seeing that slow down as a result as people try and get that inflation figure back down. So, look, I don't think it's the start of the end. I think it's more sort of possibly an overreaction in the United States that's sort of reverberating globally, which tends to happen.
You mentioned the cost of living. For people who don't have shares and their key concern is the rising prices of things, can you explain how all this relates to how the Reserve Bank here and the Reserve Bank, the Federal Reserve in the US, is trying to do something about those prices?
Yeah, so coming out obviously of the pandemic, what we've seen is that, inflation really peaked. So at the end of 2022, which is coming up to 2 years ago, so time does travel relatively fast in these scenarios. Inflation peaked here in Australia at about 7.8%, which is really high, right? Like historically, you and I have probably lived through, inflation of the 2 to 3% range, which is what the Reserve Bank was aiming for. And generally, that's what prices went up year on, year out. So to have a 7.8% increase in 1 year was really substantial and has put a lot of people under pressure. Inflation has now dropped, and it's dropped because largely central banks here in Australia and globally started increasing interest rates. So here they started in around May 2022, and they've increased interest rates from those record lows of close to 0% up to the high 4% now. So a substantial increase over time. And that increasing mortgage costs combined with that increase in the cost of living has really made, people's real living standards go backwards, right? Like if the cost of things goes up faster than your wages, over time it means that what you can really buy, or in a real sense buy with your pay packet, has gone backwards. And so we've seen really for 2 or 3 years real incomes go backwards. And the hard thing, I think, for people listening today is that, yes, mortgage costs have gone up, but also rents have gone up. And these are big expenditures, so they make up a big part of what we spend our money on. And, rents took 20 to 30%, and they've been going up by about 7% a year. So if your wages aren't keeping up with those costs, well, then you've got less to spend on other things and you feel poorer as a result.
So they've been trying to walk this tightrope of getting people to spend less money to lower that pressure on prices, but also not sending the economy into a recession. Have I got that right?
Yeah, exactly. So we talk about the narrow path, if you like, the idea being that this is a very hard thing to do. Like to slow the economy down without having a recession is a really tough gig, and not something central banks have really done successfully in the past. And I guess the concern coming out of the US is in particular, and I guess the vote that the stock market's making is, look, we think you've left rates too high for too long. And we think that your decision last week to not lower rates was the wrong one and that you're risking a recession as a result. Now, I think where we need to be a bit cautious is it's 1 month's figures, which are a bit higher than expected. Unemployment's gone up from 4.1 to 4.3%. In the grand scheme of things, they're not huge moves, and these things, can be revised. There can be statistical discrepancies, right? Like it can, 0.1% is not a big deal in these things, in hindsight. Yet the markets respond as if it's the end, we're going to have a recession, it's going to be deep. And that's what I mean about overreaction. I think, the market tends to feed off information. I mean, that's what it's meant to do, and reflect information, but it can often overreact quite significantly to small bits of additional information that don't really deviate from what we knew previously.
Could this change what the Reserve Bank might decide to do here in the next few months?
So it's an interesting question. I mean, things are really evenly poised in Australia. Like, I think there's clear signs. Obviously, the economy has slowed a lot. Inflation's come down a lot, which is good news for households. But economic growth is close to zero. Unemployment's also started to increase. So, it was at 3.5%. It's now around 4%. So we can see already the signs of those interest rate increases. There had been talk that the Reserve Bank might be considering, if we'd had like a bad, or a better or worse than expected inflation figure last week, that they might actually increase rates today. The figure that came in last week at 3.8% was broadly in line with expectations. I mean, this is what I mean. It's at 3.8. If it had been 3.9 or 4, we'd probably be talking about an increase. Like, they're so, in some ways, the differences are so minor, and yet the outcomes can be quite significant. So what we're expecting is that they will hold today, and they'll probably hold for another 2 or 3 months, I would say. They'll want to get a really good read and more confidence that that inflation figure is coming down before they move to cut. Here, things are complicated somewhat by those tax cuts that we're all possibly enjoying at the moment in our pay packets, which have added to, obviously, demand side of the economy and will help strengthen the economy, but maybe make that, inflation figure come down a little bit slower than would have happened without those tax cuts. So It's still a little bit confusing. I think for the Reserve Bank, that uncertainty means they definitely won't. Well, if they do increase, and this will go to air obviously after the decision gets announced later today, so I'll be proved wrong. But I would be very surprised if they increase today. But likewise, they're not going to decrease. They don't have the data yet, I think, to decrease today. So it's definitely a hold decision. And we'll see how they interpret this sort of uncertainty in the global outlook as well.
How significant is this moment if we're talking about everyone's superannuation, basically? Like, if you're 30 right now, can you expect this to have really any impact on what your super might be when you're in 65?
No. Look, by the time it comes out in the end of the day, it's about compound interest over time. And really, if you're in your 30s, yes, on paper, you maybe have lost some money today, but in reality, it's not going to be a big issue. And in fact, I would say even for those that are looking to retire in the next 6 to 12 months, by that stage, this is probably washed out. For those that maybe have just retired, this is a real potential decline in the value of stocks. And if they end up selling those and realising those losses, well, then that is going to be an issue. But, it's probably, in terms of the overall welfare of the population, not going to have a huge, long-lasting impact.
Well, Angela, thanks so much for explaining all that. We really appreciate it.
Oh, thanks for having me. And fingers crossed I'm not proved wrong by the time this goes down.
Thank you. Dr. Angela Jackson there. That's it for this episode of The Briefing. If you've got someone in your life who you think might want to make sense of all this stock market madness, we would love if you send them this episode. And we love if you share any of our episodes here on The Briefing, as well as subscribing to us wherever you get your podcasts. You can also follow breaking news and behind-the-scenes content across our socials. Just follow @Listener Newsroom and @The Briefing Podcast. I'm Bension Siebert. Catch you soon.